In today's update, we analyze the historic surge in gold prices as gold breaks above $4,900 per ounce and approaches the critical $5,000 level. This video covers the key drivers behind gold's rally, including rising geopolitical tensions, a weakening US dollar, Federal Reserve interest rate expectations, and declining bond yields. We also discuss short-term price outlook, potential risks, and what investors should watch closely in the coming sessions. Welcome back, ladies and gentlemen, to our financial news channel. Today is January 23, 2026, and we are here to provide an in-depth update and analysis on one of the hottest topics right now, gold prices. In today's trading session, the global gold market has witnessed a brand new historic milestone. Gold prices have continuously broken records, surpassing the level of $4,900 per ounce and moving very close to the critical psychological level of $5,000 per ounce. Most major market reports and financial news outlets are unanimously recording this powerful surge. This strong upward movement reflects a massive wave of buying driven by investors seeking safe haven assets. So, what are the key factors pushing gold prices to such extraordinary heights? The first and most influential factor is rising geopolitical tensions. Global markets are currently facing increasing geopolitical risks across multiple hotspots, including the Middle East and the Arctic region. At the same time, relations between the United States and other major global powers remain increasingly complex and fragile. History has consistently shown that whenever political instability escalates, investors tend to rush into gold to protect their assets from unpredictable market volatility. Gold, as a traditional safe haven asset, is once again proving its long-standing value. The second equally important factor is the weakening of the US dollar and the interest rate policy of the Federal Reserve. At present, the US dollar index is showing significant weakness against other major currencies in the basket. Because gold is priced in US dollars, a weaker dollar makes gold cheaper for investors holding other currencies. This currency effect has helped stimulate strong global demand for gold. In addition, markets are heavily betting that the Federal Reserve will maintain current rates or even cut interest rates during 2026. When interest rates are low, holding gold, which does not generate yield, becomes far more attractive than fixed income investments. The opportunity cost of holding gold has therefore declined substantially. The third factor comes from the bond market and broader financial risks. U.S. Treasury yields, which are traditionally viewed as another safe investment channel, are trending lower. At the same time, concerns over credit risks and the massive U.S. public debt burden continue to grow. These factors are increasing investor anxiety and driving capital flows away from bonds and into gold. Growing doubts about the fiscal stability of the world's largest economy are indirectly fueling gold's strong rally. So, how is gold likely to move during today's trading session? In the short term, gold prices are highly likely to maintain their upward momentum on January 23. Safe haven buying demand remains extremely strong and continues to act as the primary support for prices. However, we should not rule out temporary pullbacks or market volatility during the session. These corrections may be driven by profit-taking after gold has just broken historic highs. Additionally, if upcoming U.S. economic data shows signs of stability, it could temporarily slow gold's advance. Despite this, the overall trend remains strongly bullish as long as geopolitical risks and expectations of low Fed interest rates persist. Of course, every investment carries risk, and there are several important factors investors should closely monitor. If unexpectedly strong U.S. economic data emerges, such as faster-than-expected inflation cooling or a sharp rise in employment, the Fed may shift toward a more hawkish stance. Such a shift could quickly put downward pressure on gold prices. Furthermore, a sudden rebound in the US dollar could trigger a technical pullback in gold. These are key risks that investors must remain vigilant about. To summarize, gold prices on January 23, 2026 are expected to remain at extremely high levels, with the upward trend still dominating. The main driving forces include rising geopolitical tensions boosting safe haven demand, a weaker US dollar, and expectations of lower interest rates from the Federal Reserve continue to strongly support prices. Finally, capital flows are shifting away from riskier assets such as bonds and into gold. Overall, the gold market is in a powerful bullish trend and is expected to maintain its strength throughout today's trading session. Thank you for taking the time to watch today's update. We will continue to bring you the latest market insights in our upcoming reports. Don't forget to subscribe and turn on notifications so you never miss a new video from our channel. This is my personal assessment, not investment advice. You should do your own thorough research before making any decision. And always remember that no one is responsible for your decision except you. Thank you very much. Goodbye, and see you again soon.